All right, good morning or good afternoon. I do want to welcome you to the latest episode of our Bold Group Partner webinar series. This month, we have joined up with Astute Financial to talk about managing by the right numbers, top KPIs for the security alarm executive. My name is Tori Martinez. I am the Bold Group event manager, and I want to thank you for taking some time to join us today. We've got a great presentation in store for you. Let's go ahead and get started. We do have some housekeeping items as we get going today. This webinar is in lecture format and all are muted for the session. The webinar tools are available in the window on the right-hand side of your screen. To collapse the screen, you can use the right arrow to slide it out of view. To ask questions during the session, please enter them in the question section of the tools window. We will have a question and answer session at the conclusion of the webinar, and any questions we don't get to will be addressed personally via email. This session is being recorded and you can expect it to be delivered to your email early next week. If you're a SedonaOffice customer, we will also be posting it in BoldU so you can access it through your account within the next few days. So let's go ahead and get started. Please welcome Jim Lee. He is the president of Astute Financial and is our presenter today. Astute is a longtime partner of SedonaOffice, and Jim started his career in Big 8 public accounting before moving into the private industry. He was soon introduced to the value of recurring monthly revenue when he worked as a CFO for an oil and gas company whose owner also owned Terminix. You've probably heard of them, the nationwide pest control company. When the oil and gas company was sold, Jim helped co-found a new company that, among other things, made an investment in a small wholesale monitoring operation. And soon Jim and his partners were all in, purchasing several alarm companies and thousands of subscriber accounts, eventually opening a state-of-the-art central station using software from none other than Bold Technologies. So fast forward to 2008, Jim supervised the implementation of SedonaOffice for an alarm company he was managing at the time. And then in 2010, he founded Astute Financial, where he and his team focus on supporting SedonaOffice customers with consulting, accounting, and reporting solutions. So I want to welcome you, Jim. We are pleased to have you with us today, and we look forward to hearing your presentation.
Thank you, Tori. I appreciate that intro. And I want to thank Bold for sponsoring this Bold Group Partner webinar. It's great to be with everyone today and to have the chance to explore a little bit about what I've learned over the years in my roles as a financial officer, general manager, and consultant in the alarm industry. As Tori mentioned, I worked for a startup alarm company back when a company's controller looked hip, lugging around a 30-pound portable compact computer with floppy disks. In the late 80s, our alarm company used a DOS-based accounting system. We processed recurring billing using custom software developed on a mainframe computer, and of course, we used spreadsheets extensively to track operational activity. Our accounting department produced basic financial statements and managed to compile a few reports in Lotus 123 that our executive team used to manage the company. Well, we've come a long ways from those days with sophisticated software like SedonaOffice and powerful reporting tools like Vivid Reports and Sedona Sync. A current day accounting team can deliver a wide array of financial and operational reports with literally hundreds of KPIs and metrics. Some time ago, I was in a meeting with the owner of an alarm company, a customer of ours. I was excited to show him the latest versions of the Vivid CPM financial statements and Vivid Flex reports we had developed. I thought the meeting went well, but my customer's reaction told a different story. He was obviously overwhelmed by the volume of data. Eventually, he asked me to identify the top 5 KPIs, or key performance indicators, that he should pay attention to. And honestly, at the time, I couldn't answer his question succinctly. I pointed out 10 or more that I thought were very important. Since that meeting, I've sharpened my analysis, and today, while I'm not down to 5 KPIs, I will explain why I believe the following 6 Financial KPIs are as important as any to the alarm company executive. Return on assets, net attrition rate, existing business margin, RMR creation cost multiple, labor utilization, and labor cost rate. Before exploring each of these KPIs, I want to take a short moment to address a basic question I am often asked, which is, what is the difference between a KPI and a metric? Well, the difference is subtle. First, keep in mind that every KPI is a metric, while not all metrics are KPIs. A KPI tracks whether you hit a business objective or target. For example, you might set a target of re-signing 40% of customers that relocate to a new location within your geographical market area. The 40% target is a KPI. The average number of customers that move within your market over a period would support the KPI and would be considered a metric. Metrics support KPIs and track the status of specific business processes. Taking this example one more step, tracking the percent of customers that are successfully contacted by your customer retention team would be a metric because it provides information about your internal process of following up with customers that are moving. Bottom line is that the difference between a KPI and a metric is subtle, and you should feel comfortable using the terms interchangeably, which is exactly what I will do in this presentation. Okay, let's look at the first KPI on my list, return on assets. This very important metric is calculated by dividing adjusted EBITDA by average assets at fair market value, where assets include RMR. EBITDA is, of course, earnings before interest, taxes, depreciation, and amortization. The adjustments to EBITDA include what we call the RMR value adjustment, which is the change in value of RMR for the period in question, and any owner expenses that are not considered essential for maintaining company operations. The result in this example is about $1.3 million of adjusted earnings on nearly $20 million of average assets, again at fair market value, for a return on assets of 6.6%. Return on assets is at the top of the list for a couple of reasons. First, this is the KPI that gives an alarm company owner a way to compare their investment to other alarm companies and to investments outside of the industry. With a simple search of the internet, you can find how the stock market has performed historically. For instance, this slide shows the average annualized returns for the S&P 500 and Dow Jones indexes for the 20 years ending June 30th, 2019, which of course includes the dot-com decline starting in 2000. Well, everyone knows the volatility of the stock market, and this is evidenced by the comparison between 2017 here and 2018. I would make the claim that an investment in an alarm industry is generally less volatile than an investment in the stock market. And based on recent conversations with our clients, I think it's held up generally pretty well in the age of COVID-19. Still, an alarm company owner has a choice, which is to keep their money working in their company or to sell their company and invest the proceeds elsewhere. It's a choice that I think Michael Barnes, a longtime financial consultant in our industry, describes pretty well when he says, every day you don't sell your company at market value, you are buying it at that value. Inferred in that statement is the need to know the return you are generating on your investment in your company. Return on assets is the KPI that may be the most helpful for you in making that buy-sell decision. The second reason return on assets is at the top of the pyramid is because the next three KPIs in the list, net attrition rate, existing business margin, and RMR creation cost multiple, directly impact return on assets. To provide some perspective, let's look at a simple illustration of how an investor would calculate their rate of return on the purchase of a block of alarm contracts. Let's say the investor purchased 400 subscriber accounts having an average monthly monitoring fee of $25, representing $10,000 in total of RMR at a 35 multiple for a $350,000 investment. Let's also assume the investor outsourced service by paying an alarm company $10 per account per month for monitoring, servicing, billing, and collecting services, so that the operating margin was $15 per account, or 60%. With a 9% annual attrition rate, the RMR remaining after 5 years would be about $6,400. So let's further assume that the investor sells the remaining RMR at a 35 multiple again for about $224,000. The cash flow over 5 years would generate an internal rate of return of 11% in this simplified example. The important point to make here is that the return on purchased accounts depends on 3 things: the amount of investment, the cash flow from operations, which, by the way, is impacted negatively by attrition and the residual value of the asset, which again is depleting because of attrition. Alarm companies have choices. They can purchase RMR or they can create RMR. They can employ staff to service customer systems, or they can outsource servicing to a third party. They can run a monitoring facility or outsource this critical function to a third party. They can invest in smart customer service strategies and processes to lower attrition and increase customer satisfaction, or they can let the chips fall where they may. These choices are not mutually exclusive, of course. Many alarm companies purchase RMR and create RMR internally, and many outsource the monitoring function while employing staff to service customer systems. Regardless of these choices and the nature of a particular company's operations, alarm company owners and executives should know the returns being generated on the market value of company assets. Again, just quick look at Michael Barnes' statement. Return on assets is the KPI that answers the question about overall performance of your company and can help you affirm your decision not to sell, but rather to continue operating your company. So now we're going to talk about the key components that drive return on assets, where investment correlates to the cost of creating RMR, cash flow from operations correlates to existing business margin, and attrition impacts operating margins and residual value. Let's start with a few observations about attrition. Unfortunately, attrition happens. You have little or no control over some of the reasons for why customers cancel, such as when customers move, businesses close or sell, and someone falls on hard times, or they no longer see a need for the service. You have more control over situations where customers become dissatisfied or have been approached by competitors. For example, you can take proactive action when customers move to re-sign the new customer moving into the vacated premise, or to re-sign the customer moving into their new location. Re-signs are deducted from gross cancellations to derive net cancellations, and therefore your net attrition rate. Certainly, there are many smart customer service strategies and processes that can help your company reduce attrition and improve your success at re-signing customers and overall customer satisfaction. With respect to customer service, I'd like to give a plug for OPT Business Services, whose recent Bold Group Partner webinar focused on improving customer experience. OPT has a deep understanding of what can be done to improve customer experience across your organization and has software solutions to make it happen efficiently. You would be wise to check out the webinar. My experience working for an alarm company in the early 90s informed how I think about customer service. I helped a company in Colorado purchase 1,000 subscriber accounts, and I went to work for them as the financial controller, as well as the main customer service representative for these 1,000 accounts. I carried a printed list of the accounts in my car with names, addresses, phone numbers, obviously before the era of smartphones and tablets. The office would call me whenever one of these customers had an issue or were moving. And let me tell you, I was Johnny on the spot. I would return the call as soon as possible and visit the customer if necessary. If the customer was moving, I would drop off my business card and a packet of information for the new owners and do my best to re-sign the moving customer to their new home. Not only was I able to keep net attrition low, I was able to sell add-ons and upgrades and a few full system installations, all with enough margin to cover my salary, usually on a monthly basis. It was a winning strategy that I was able to apply for other companies later in my career. The point of the story is that managing attrition requires strategies and processes, like the basic ones I employed, as well as more sophisticated ones available today. The impact of lower net attrition on operating margins and market value is a significant factor in the return on assets generated by your company. You may have noticed that I've used the term new business and existing business, and you may be wondering how they are defined. Well, there's no authoritative definition that I'm aware of, but the definition really matters, because what you define as new business can dramatically affect your company's RMR creation cost multiple. Existing business incorporates the activities your company would perform whether you were in the business of creating RMR internally or not. You would, of course, perform the functions of monitoring alarms and servicing systems, and you would also work to provide a level of customer service that would reduce account cancellations and maintain customer satisfaction. This means you would provide add-on services and upgrades to systems to meet customer needs and requests. You would also work to retain recurring revenue when customers moved. You would also work to re-sign moving customers to their new locations. The revenue and the expenses associated with existing business, as well as the RMR generated from these activities, are existing business, and therefore would not be included in new business and would not factor into the calculation of RMR creation cost multiple. Based on this definition of existing business, then remaining activities are those related to the installation and takeover of systems for new customers, which we refer to as new business. Administrative and support functions performed by office personnel represent expenses that are shared between new and existing business activities and include billing and collections, accounting and HR functions, purchasing and inventory, project management and scheduling, and general management. Shared expenses must be allocated between new business and existing business in a thoughtful manner for accurate calculation of RMR creation cost multiple and existing business margin. So let's move on and look at RMR creation cost multiple. This KPI is calculated by dividing net creation cost by the amount of RMR created from new business. The costs in this example include direct costs of about 4.2 million and indirect costs of about 2.4 million, and then revenue of about 5.6 million is deducted to derive the net creation cost of about 1.1 million, which when divided by RMR created of about 38,000 results in the creation cost multiple of $27.70. So that $4.2 million in direct costs, you can see here what that is comprised of: parts, labor, commissions, subcontractors, and other costs. These are the costs, direct costs charged to jobs for installation and takeover of systems. And depending on how you are accounting for job costs in your general ledger, these numbers from in your financial statements would be the same numbers that you would basically see in the job costing screen in SedonaOffice. So back to the RMR creation cost multiple screen, note that the indirect cost allocations include standard cost variances such as parts overhead, and expenses related to personnel and field support such as project managers and schedulers, personnel in sales and marketing, and personnel in G&A such as officers, accounting, HR, etc. How you allocate operating expenses between new business and existing business operations requires some analysis. The banks in our industry typically include a covenant in their loan agreements called the fixed charge coverage ratio, and that this ratio requires calculation of RMR creation multiple, and therein requires allocation of operating expenses. Calculating this ratio, the fixed charge coverage ratio, requires calculation of RMR creation cost multiple, which in my experience, the banks typically stipulate that 90% or more of sales and marketing expenses and 50% of G&A and field support expenses be allocated to RMR creation costs. However, what might work for a bank is not necessarily what might reflect reality. With some thoughtful analysis about what shared operating expenses should be reduced were you to eliminate new business activities, you might decide to allocate the cost of shared administrative and support functions differently than what your bank stipulates. The goal, of course, being that you want the RMR creation cost multiple that you calculate to be as realistic as possible. Of course, sharing, and also keep in mind, shared operating expenses that are not allocated to new business then by default are included in existing business. A lot of accounting. Before we move on to existing business, I'd like to point out that there are different ways to do job costing in SedonaOffice. The examples in this presentation assume the use of standard costs for parts and labor in the financial statements. And what this means is that the variance between actual technician-related expenses and parts and standard costs must be accounted for. Now, we're not going to delve into job accounting and standard cost accounting today, but this slide shows how we arrived at the $35,000 credit for standard cost variances included in the illustration of RMR creation cost in the previous slide. There are different ways to allocate these variances, but note that 70% of the parts cost variance has been allocated to jobs or new business, which means 24% has been allocated to existing business. The same concept applies to the allocation of labor variances. Calculating a realistic RMR creation cost multiple is paramount to understanding how efficient your company is at creating RMR internally through marketing, sales, and installation operations. In my experience, I would say that a 30 times multiple is a good benchmark for gauging how you are doing. It's also the multiple most often stipulated by the industry banks as the maximum multiple that can be used in the calculation of steady-state cash flow. To provide perspective, if you added RMR at a 30 times creation cost multiple, and that RMR is worth more than 30 times, then you are adding value to your company from new business operations. Of course, no one knows the true value of RMR until you purchase or sell a block of accounts and that transaction is consummated. So my advice is to strive to create RMR at a multiple of less than 30 times, which of course is easier said than done in a competitive environment. Most importantly, don't fool yourself. Make sure your calculation of RMR creation cost multiple reflects reality. So let's move on to existing business operations. Whether you purchase alarm accounts or create RMR internally, the margins you generate on existing business will directly affect return on assets. While the margins on existing business can vary between companies, the margins are usually steady month after month for any one company. In particular, monitoring margins are usually very steady, assuming you are accounting for monitoring revenue on the accrual basis of accounting, as is easily done in SedonaOffice. There would not be any large changes in monitoring revenue unless you purchased or sold a block of accounts. Likewise, the direct cost of monitoring your accounts, whether you run a monitoring facility or outsource that function, should be relatively steady month after month. The differences in monitoring margin between companies is often related to the direct cost of the monitoring function. Companies that outsource the monitoring function can often negotiate relatively low prices. Companies that run their own monitoring facility must attain a certain level of economies of scale that drive down the cost per monitored account. Here's a simple example. On the left, where you see the monitoring fee is $30, the margin is 80% when the monthly monitoring cost is $6, and it drops to 67% when the cost is $10. Monitoring price can significantly affect margin as well. On the right, with revenue of $25 and the cost of $6 per month, the margin is 76%. Raising that price to $35 with the same monthly cost of $6 results in a margin of 83%. Margins on service work are often relatively steady, but are more volatile compared to monitoring. There can be wide margin differences between service and inspection work and between time and material and work for customers who are covered under extended warranty contracts. For example, in this example here, the company generated an 18% margin on service work for time and material customers, a 44% margin on service work for contract customers, and a 43% margin on inspection work, resulting in a margin of 28% overall. For what it's worth, I can tell you that what I see more often is that margins are better on work performed for customers covered under extended warranty contracts. However, whether you service customers strictly on a time and material basis or sell service contracts or do both, your company benefits from that steady source of service revenue. I want to point out that add-on, upgrade, and re-sign activities, while part of what we define as existing business, is work that is not always performed by service technicians. Installation technicians often do system add-on, upgrade, and re-sign work, but it's also common that office personnel handle re-signs without the need of sending a technician to the premise. This dynamic highlights the need for sound cost accounting methods to ensure labor costs are accurately associated to the type of work being performed. The good news is that GAAP-based cost accounting is easy to achieve in SedonaOffice. Here's a financial statement that combines new and existing business and shows two of our top KPIs, RMR creation cost multiple and existing business margin. Overall, the company's combined net operating income margin was 3% for the year, but Obviously, this margin alone does not tell the whole story. Net operating income for existing business was a healthy $1.5 million, while net operating income for new business was a loss of nearly $1.1 million. However, don't despair. The company added 38,000 of new RMR at a creation cost multiple of $27.70, which is what we saw earlier, which is below the benchmark of 30 times that I also mentioned earlier. This statement paints a meaningful picture of the company's performance from both new and existing business. After properly accounting for new and existing business, we can put the numbers together to calculate return on assets, the KPI at the top of our list. And you can ask yourself some questions like, does this return justify the risk associated with operating the business? How does this return compare to other investment opportunities? How can we improve return on assets? The last question, how can we improve return on assets, provides a tidy segue to talk about the last two KPIs on our list, labor utilization and labor cost rate. As you might expect, there are many elements of your business that, if improved upon, could drive higher return on assets. Lowering costs for products and services, implementing better inventory control, improving your net promoter score are some examples. All would contribute to a better return on assets over time. Labor utilization and labor cost rate are uniquely important because of the immediate impact the results can have on earnings. It's not uncommon that a downturn in RMR creation cost multiples or service margins can be traced to lower labor utilization rates. Labor is a limited resource, and the resource, which is people, must be actively managed to ensure performance stays on track with expectations. Both KPIs are easy to calculate. On the left is a summary of technician hours for a month. 5,000 hours were charged to jobs and service work, 500 hours to holiday and PTO, and 2,900 hours to other non-chargeable time, for a total of 8,400 hours reported, which would have been reported to your payroll. On the right, utilization is calculated for total hours at 60%. That's 5,000 hours divided by 8,400 total hours, and to available hours at 64%, the same 5,000 hours on jobs and service divided by 7,900 hours, which would be the 8,400 hours less the holiday PTO time. Below utilization, monthly technician expenses are $286,000, which is comprised of wages, payroll taxes, benefits, vehicles, and other field technician expenses. This $286,000 is divided by, again, the 5,000 hours on job and service, and gives us the fully burdened labor cost rate for the month of $57. One thing to note, job and service hours in this example represent on-site hours. In SedonaOffice vernacular, that means arrive time to departed time. Travel time is included in the 2,900 hours of other non-chargeable time. Now, there are arguments about whether travel time should be considered productive time, but most companies we work with consider travel to be non-chargeable time. And for this and other reasons, I personally am a proponent of treating travel time as non-chargeable. One last point about labor. There are benefits to entering all technician time into SedonaOffice on a weekly basis and reconciling these hours to your payroll records. First, any data entry errors can be addressed while the week's work is still fresh on everyone's mind. Second, technicians tend to do a better job entering time when they know that what they enter will be reviewed sooner than later. Third, managers and technicians will have access to labor utilization reporting on a weekly basis. And fourth, technicians tend to be more productive when they know utilization is being tracked. Human nature. There are different ways to enter or pull non-chargeable hours into SedonaOffice, so reach out to us if you have questions. The alarm industry is comprised of several thousand companies, and I wouldn't be surprised if each one had a different opinion about what KPIs are most important. For me, return on assets is at the top of the list, followed by the three that most directly impact it: net attrition rate, existing business margin, and RMR creation cost multiple. Of the many KPIs and metrics that with improvement could help your company produce a better return on assets, labor utilization and labor cost rate are two that can have an immediate and substantial impact. I would love to hear what each of you think. So either in this webinar now or in an email later, just shoot me your thoughts, and I'd love to talk to you about it. Before we take questions, I'd like to share some information about our company. Astute has worked closely with SedonaOffice since 2010, and we've been a premier partner of Vivid Reports since 2012. We have provided financial consulting, accounting assistance, and reporting solutions to over 100 companies that use SedonaOffice. Our reporting solutions leverage the incredible functionality of Vivid CPM for financial statements and budgeting, and Vivid Flex for general report development. Our monthly business analysis report is perhaps the best illustration of the power behind the Vivid reporting tools. We use both CPM and Flex to pull financial and operating data into this comprehensive month-end review that is designed for alarm company owners and executives. The snapshot page charts the top KPIs and compares 26 key metrics to targets. Additional pages provide insightful supporting information on operating results, RMR, attrition, sales, jobs, service, and labor. Calculations of RMR creation cost, existing business margin, and return on assets highlight the final pages of the report. A summary page gives the CFO or accounting manager a place to comment about the key metrics for the month in review. So please contact us if you have any questions or would like a demo of the Vivid reporting solutions. So I've come to the end of my presentation, so I'll turn it back to Tori now.
All right. Thank you so much, and I do appreciate your time, Jim, and appreciate everything. We do have a couple of questions that have come in, so we are going to get started with those. First one, why use ROA instead of ROE?
Well, that is a good question, and a related question might be what return on investment. Again, there are subtle differences. You still want to use the earnings generated from your company, but it's just a matter of what you use those earnings to calculate. Return on assets, the reason I like that is because it is more it's comparable between companies. When you look at return on equity, you're really dealing with issues around what is the leverage in the company, how much debt do they have compared to equity. So return on assets is just a more is a metric that can be compared across companies more easily.
Okay. Another one we have here is, does steady state cash flow factor into the calculation of return on assets?
Well, and I mentioned in the presentation that steady state cash flow is something that the banks use. And the idea of steady state cash flow is that companies are using their their operating cash to create RMR. Okay, and so the normal EBITDA that a company would generate in a different industry would not have that element of it. It would just be whatever cash flow is created from operations. Whereas in an alarm company, so much of that cash is being used to create new RMR that now EBITDA is much lower than it typically would be. So what the banks have done is they've said, let's take and calculate how much cash would have been used just to replace attrition, okay, and get us to what we call a steady state point. And then any additional cash that's used to create recurring revenue over and above that attrition would be cash that we can add back to EBITDA to get to what's called a steady state cash flow point. So they use that metric, the steady state cash flow, as a way to in their different covenants they have in their loan agreements.
Okay. And how about this one? Are there benchmarks available for industry KPIs?
Well, there are some. For instance, a company, TRG, some of you may have heard of TRG. They've been compiling numbers on cancellations for quite a number of years now. And so a lot of the companies in the industry contribute to that annual survey, and TRG compiles those numbers and publishes the results. And a lot of times, those numbers are published in some of the trade magazines. So on cancellations, yeah, there are some benchmarks there, and attrition. There's some private industry groups like Net1 and ESTA that the members of the group share information between the members of the group, and those metrics are used by each of the members to benchmark from. But no, at the moment, there's nothing I would say, like on some of these metrics we're talking about today, return on assets and creation cost multiple and all of that, there's really nothing publicly available, although that's something that we are moving toward. We're working with a group of companies to help compile those kind of benchmarks that someday I hope will be available to the industry.
Okay. Do you track new and existing business separately in SedonaOffice?
Well, you certainly can. Really it comes down to, of course, existing business. It includes monitoring and service, and that's easily tracks with categories in SedonaOffice. It really, a little bit of a consideration is how you track your jobs in SedonaOffice. And again, you can use categories so that certain job types flow into the new business category, and add-ons, upgrades, re-sign type work would flow into the existing business category. So you do that to make it just makes it a lot easier to pull all the reports together and calculate these metrics. But if you don't do that, if you don't use the categories that way in Sedona, we can usually get to the numbers anyway by going directly to like the job tables with our reports.
Okay. And I think this was an earlier question. You may have actually answered this one a bit, but is there a difference between return on assets and return on investment?
Yeah, and that's basically the same as the question about return on equity. So assets, again, is a more universal KPI that can be compared with other companies, where return on investment or equity you have to take into account the amount of leverage in your company. And so what I see in when we calculate return on asset and return on investment or equity with our customers, the companies that have purchased a lot of accounts and are more highly leveraged with 20 times recurring leverage or that sort of thing, they're typically seeing a higher return on equity or investment because of that leverage. Of course, everyone has heard leverage is a double-edged sword. So if things were to slow down and profits drop off, then they may experience a larger loss or a negative even return on investment or equity. So yeah, but basically the same question.
Okay. Well, that's all the questions we've received right now. And of course, if you think of one later, feel free to reach out to Jim, and we will send his contact information out when we send the recap of the webinar. But for now, that's what we've got. Just a reminder, we have recorded the webinar. You'll receive a copy in your email early next week, and we will be posting the recording for those of you who are subscribers to Bold You. So if you're a SedonaOffice customer, you can access it through your account within the next few days. But for now, thanks again for attending, and we do wish you all a great day and the great rest of the week, and happy Labor Day weekend, everyone. So enjoy. Thank you so much for attending.